Short selling is a trading strategy where an investor sells a financial asset, such as a stock, that they do not actually own. The investor borrows the asset from a broker or another investor and immediately sells it on the open market. The goal of short selling is to profit from a decline in the price of the asset. Here's a step-by-step breakdown of short selling. The investor identifies an asset that they believe will decrease in value, such as a stock. They borrow the asset from a broker or another investor, typically through a margin account. The borrowed asset is immediately sold on the open market, generating cash for the investor. At a later time, the investor must buy back the same asset in the market to close out the short position. If the price of the asset has indeed fallen, the investor can buy it back at a lower price, profiting from the price difference. The investor returns the borrowed asset to the lender, typically by buying it back on the market. If the price of the asset has increased instead, the investor may incur losses since they need to buy it back at a higher price. Short selling allows investors to potentially profit from downward price movements and can be used as a speculative strategy or as a hedge against existing long positions. However, it also carries risks, as there is no limit to how much the price of an asset can rise, which could result in significant losses for the short seller.